Consumer Price Index, or CPI, is basically the main measure for inflation and the cost of living. CPI is calculated by looking at the cost of what is considered to be a general basket of goods that we would all use. Periodically, this basket of goods, the cost of which is going to change over time, and that actually reflects our spending patterns. So inflation is basically the increase in terms of prices of goods and services that we use within the economy, and CPI is really just the measuring stick for this. Now, inflation above 3% is actually considered to cause problems within the economy. The reason for this is that high inflation will put interest rates up, and that will then in turn push up the cost of debt. So to meet those extra repayments, employees will start putting pressure on their employers to get a wage increase, to pay for this extra cost of debt. To pay for that extra cost of wages, employers will then have to bump up the costs of their goods and services. So the knock-on effect goes from there. This is why the RBA will use interest rates as a lever within the economy to keep that inflation rate between 2 to 3%.